Understanding option Greeks are critical if you want to go into options trading and be successful at options trading. Today, I'm going to cover the most important option Greeks that you need to understand and how you can implement that to become a successful options trader. Let's go. Welcome back, guys, to another video. My name is Nick, and on this channel, we focus on positive investing. If you like these videos and want to learn more about options, make sure to hit that subscribe button down below and don't forget to hit that bell notification so you don't miss anything. Now let's get into it. Alright, so first let's list off the 5 different terms or Greeks that you need to understand if you ever want to be a successful options trader. So they are theta, gamma, vega, rho, and delta. However, before we get into these 5 Greeks, let's first talk about implied volatility. Although it isn't a Greek letter, it is very important to understand this to trade options. Pretty much all you need to really understand from this is that the higher the IV or implied volatility is, the more expensive the option contract is. The lower the IV, the cheaper the option contract is. When you hear terms out there like IV crush, all that really means is that the IV or implied volatility dropped drastically. Now this can usually be caused by a certain event, and earnings, and acquisition, maybe some competitive news. Those kind of things really drop the IV in a certain contract. So a good thing to understand is as a company runs up to its earnings report, say its earnings report is in a month, as we approach that earnings report, you'll see the IV start to ramp up. Now once we hit that earnings report, you'll notice the day after, typically the IV is crushed, and you'll notice that it's a significant drop from what it was the day before earnings report. So a lot of people, especially options traders, try to take advantage of this, and they buy option contracts, say about a month before earnings. They hold it up until maybe a couple of days before earnings, and then they sell off the option contract, and they just take advantage of IV to make profits off of that. Okay, so now let's start talking about the 5 different... Alright, so now let's start talking about the actual Greeks, what they are, and how you can use them to become successful at option trading. Okay, so first off we have delta, which tells you how much an options price is expected to change per $1 change in the underlying stock price. So for example, if we have a delta of 0.5 on a certain option contract, that means that if the underlying stock moved up or down by $1, the actual option contract would move by 0.5. But remember, a 0.5 move is actually a $50 move, because when you look at options, it's always multiplied by 100. So 0.5 times 100 is 50. So what you need to understand here when you're looking at delta is that call options have a delta from 0 to 1, and put options have a delta from 0 to -1. If you are planning to pick up call options, you want a delta that's higher or closer to 1. And if you're planning to pick up put options, you want a delta that's closer to -1. Now the deeper in the money that you are, the higher the delta typically is, and typically is close to 1. Now if you're not sure what in the money means, make sure to watch the previous videos I've made on this option series. I'll leave a link up here if you're not able to find it, and I would strongly recommend you watch that before continuing on with this video. Alright, so the second Greek that we have is gamma, which measures the rate of change per $1 change in the underlying stock. So for example, if the delta is 0.5 and the underlying moves by $1, the new delta isn't necessarily going to be 0.5 as well. The new delta, in fact, is calculated by using gamma, which for example could be 0.1. So in this case, if the gamma is 0.1 and the old delta was 0.5 and we had a stock movement of $1 in the underlying, the new delta would be 0.5 plus 0.1, which is 0.6. So the third Greek you need to understand is theta. And theta simply tells you the value that an option contract loses over time. The lower the theta is, the better the option contract is, because you have more time on your side. The closer the option contract is to expiry, the higher the theta is, and the more value the contract loses as you approach that expiry. The lower the theta, the better the contract is, because you have time on your side. The higher the theta, ideally typically you want to avoid that, because high theta means that you're going to be losing a lot of value in that contract as time goes by. So for example, if an option contract has a theta of 0.03, that means that every day that goes by as we approach expiration in that contract, your contract value is lost by 0.03. And like I said, as we get closer to the expiry, this is going to exponentially ramp up. Alright, so the fourth Greek you need to understand is VEGA. And what VEGA does is it measures how the implied volatility of the stock affects the option contract. The key thing you need to understand here is that as VEGA decreases, calls and puts lose their value, and as VEGA increases, calls and puts increase in value. Okay, so the last Greek that I'm gonna mention, which I don't really pay too much attention to, but again, it is important to understand and know what it means and what it does, is rho. And rho pretty much tells you how sensitive an option contract is to interest rates. So typically, as interest rates increase, call option values increase as well. And inversely, as interest rates increase, put options decrease in value, and that's because they have a negative rho. Anyway, so I know this is very confusing, especially if you're a beginner and this is your first time trading options, but do not get overwhelmed by these Greeks. Now, although all of these things that I covered today are important to understand and follow, the ones that I typically look at when I trade options, especially when it's a swing trade or a short-term trade, I look at the IV, the theta, and the delta. Now, of course, I'm obviously going to look at the other Greeks as well, but these three really help make my decision. What I typically look for is low IV, high delta, and low theta. What this does is it gives me a good value with the low IV. So as IV increases, my option contract increases as well. A high delta, so if the underlying moves up at a faster rate, that means the option contract is also going to move up at a fast rate. And a low theta, because if for whatever reason the trade doesn't go in my favor in the short term, I have time on my side. So a combination of these three things is typically, again, what I look for, and I personally think that those are the three most important Greeks to look at, especially if you want to get a nice value out of your option trades. So now, as a bonus and a thank you for sticking around up to this point in the video, I'm going to go over a real world options contract and walk you through step by step the things that I look out for when I go for option contracts like these. So if we pop up Facebook here on the screen, you can see that I have the Facebook September 21st, 2018 $200 call option contract open. So the current price of the contract is $9.80 per contract. The delta is 0.55. So this means for every dollar that Facebook stock moves up, the option contract increases by 0.55, which is 55 cents. The theta on this is 0.07 or negative 0.07. So all that really means is every day that goes by, the option contract loses 7 cents of its value. So tomorrow, for example, this option contract would be worth 9.8 minus 0.07, which leaves me with 9.73. Finally, the IV that I look at is 0.16. So I personally typically look for IVs that are below 20 or 0.2. And this is because I find that this is a good value for an option contract, especially for tech plays. And what you really need to remember here is that the higher the IV is, the more that you're paying for the value of this contract. So typically you want this to be as low as possible to get the best bang for your buck. So overall here, I'm very happy with this particular contract. It has low IV, low theta, and a pretty high delta. So if Facebook stock moves up at a rapid rate in the short term or even the long term, this delta is going to help move the option contract up significantly as well. But now say the stock moves down in the short term or moves sideways in the short term, theta isn't too bad, it's only 0.07, so I'm not going to lose too much value holding this even if I hold it for a few months. Now the last thing was the IV, which was less than 0.2, and this means that the stock isn't really going to experience an IV crush, but as we approach earnings, you'll notice that this IV is going to increase dramatically, and you could even get close to 0.3, 0.5, really depends on the catalyst and what analysts are expecting and investors are expecting for that earnings report. So yeah, that would be pretty much an exact example of a contract that I would look at and I would consider investing in or kind of swing trading in. Now remember, there are different strategies you can do with option contracts. Some expire weekly, some expire monthly, some expire yearly. So you really want to pick based on your risk tolerance because you don't want to be left stranded with $0 because the option contract lost its complete value. Anyways guys, thank you so much for watching. Leave a like on this video if you enjoyed it. Don't forget to hit that subscribe button down below. And don't forget to invest positively. Peace.